Good morning. These are the things that matter most in Europe's market today. Iran pressure is keeping oil risk alive. Uber and Pony.ai are turning robotaxis into a European mobility test. Chinese technology is becoming harder for global companies to ignore, and the AI financing chain is still asking for proof from chips, power, and software. The central question is simple. Can Europe keep following the global AI and risk asset rally if energy costs, China competition, and financing selectivity all test margins at the same time? Start with Iran and oil. CNBC reported that the U.S. is preparing economic tactics on Iran that officials described as measures not seen before, while markets are still watching the wider conflict risk. The Yahoo snapshot shows Brent near $87 and U.S. crude above $81. That keeps energy risk active even while volatility remains relatively calm. For Europe, the cleaner side is integrated energy and energy security exposure. Shell, Total Energies, and BP. Pressure sits with fuel-sensitive airlines and cost-sensitive industrials, especially Ryanair, IAG, Lufthansa, and chemical producers where input costs can move faster than pricing power. For private investors, the useful filter is who pays for the oil risk. If crude stays firm, does Europe reward energy cash flow, or does the market treat oil as a tax on the rest of the equity tape? Second, mobility is becoming an AI deployment story, not only a car story. CNBC reported that Uber and China's Pony.ai plan to deploy 2,000 robotaxis in Europe. That does not make every mobility stock an AI winner. It creates a test of who owns the platform, who supplies the vehicle, who absorbs regulatory and safety costs, and who loses pricing power if autonomous supply increases. The cleaner side is software, fleet technology, mapping, sensors, and charging infrastructure. Pressure sits with traditional car makers and ride-hailing economics if robotaxis lower fares faster than they raise returns. In Europe, the names to watch are Volkswagen, BMW, Mercedes-Benz, Stellantis, Renault, Valeo, and Continental, with Uber as the platform reference point. For private investors, the practical takeaway is this. Robotaxis are exciting, but the market test is margin capture. Watch whether Europe prices this as a new revenue pool or as another competitive cost layer for car companies and suppliers. Third, Chinese technology is becoming harder for global companies to ignore. CNBC framed the issue from Apple to Ford, and Investing.com reported stronger Chinese chip and robotics headlines, including SMIC price increases tied to AI demand and LG working with NVIDIA on robotics and AI factory development. That matters for Europe because China exposure is not one basket. Potential beneficiaries are companies selling scarce tools, chips, and automation equipment. ASML, Infineon, STMicroelectronics, Siemens, and Schneider Electric. Pressure sits with European car makers, industrial suppliers, and luxury names if Chinese competition improves faster than European pricing power. For private investors, the filter is separation. Do not treat China as simply good or bad for Europe. Ask which companies sell into the technology build-out and which companies compete against it. Fourth, the AI financing chain is still alive, but it is becoming more selective. Investing.com reported Goldman talks linked to NVIDIA financing, while CNBC highlighted the scale of SK Hynix's AI build-out and ongoing AI company capital market activity. At the same time, MarketWatch noted a calm market mood as investors chase the rally. The cleaner side is where AI demand turns into orders, capacity, or cash flow. ASML, SAP, Schneider Electric, Siemens, and Infineon. Pressure sits with companies that borrow the AI label but cannot show conversion, and with crowded momentum trades if the market stops rewarding every headline equally. For private investors, the takeaway is not that AI is over. It is that proof matters more as valuations rise. The question is whether orders, margins, and balance sheet capacity confirm the story. Here is the stock-led watch list. First, Shell, Total Energies, and BP versus Ryanair, IAG, and Lufthansa. Does oil act as energy support or a margin tax? Second, Volkswagen, BMW, and Stellantis. Does the robotaxi news read as opportunity, threat, or simply long-term noise? Third, ASML, Infineon, and Schneider Electric. Does the AI capex chain confirm in European infrastructure stocks? And fourth, LVMH, Hearing, and Mercedes-Benz. Does China competition hit premium pricing power or stay contained? Market bias, selective and proof-driven. Europe can still benefit from a global rally, calm volatility in AI spending. But the stronger setup is in companies where the mechanism is visible. The mistake to avoid is treating every exciting theme as investable today. For private investors, the useful question is not whether oil, robotaxis, China technology, and AI matter. They do. The question is which company groups confirm the story on the tape. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.